Hey, so this is part 2 of the types of mortgages that exist. We're going to talk about the 2 that don't require a down payment, as well as a little overview of the difference between a fixed and adjustable mortgage rate. So my name is Glenice Johnson with Artformhomes and eXp Realty, and I'm a realtor in the greater Birmingham area. So, little disclaimer, it is the middle of March. I'm filming this in February, but right now when it's posted is the middle of March, and if my baby has not been here last week, he's definitely here now, and I most definitely am on maternity leave. And so I am still available for text and through email if you have any questions, but I am definitely on leave from doing any major buyer's consultations or any showings or things like that. I'm gonna definitely, because I'm not moving around a lot, and so definitely taking the rest of the month off to kind of spend time with my baby, let my body heal and all that good stuff, so I can get back out there with you guys. But I just wanted to make that disclaimer. So last week we talked about conventional loans, we talked about the FHA loans. So this week we're going to finish up with the other federal loans that exist, which are USDA and VA, and again talk about fixed and adjustable mortgage rates. So USDA loans, which is the U.S. Department of Agriculture, is basically the loans for lower income buyers in rural or suburban areas. And so that's kind of the catch, actually, because even though you're not paying a down payment, you're restricted to homes that are in rural areas, and to the point where you actually have to put the address into the USDA website to make sure that it qualifies. Now, in my experience, the homes are not like in the sticks, they're not like in the booms, just completely obscure locations. They're still in pretty solid. They're still generally close to major areas. They're just a little further out, and so I tend to if I've got clients that are kind of concerned about down payments, I say, look, talk with your lenders, see, you may be able to qualify a USD loan. You just know that your options are a little bit limited, and if you're not too picky about the area you're trying to be in, it could be a great benefit. So the debt to income ratio on that is at 41%. I had to look at my notes, I'm sorry. It's at 41%. Again, it's in the 40s. So if you're able to get that debt to income down to 40%, you got broad coverage. So that's USDA. The other one is, of course, VA. When I say VA, I am talking about Veteran Affairs. So this is for all of my veterans and military service people and their families. And let me tell y'all something. Y'all get some perks with this loan, and you absolutely deserve it for all of the sacrifices you make to keep this country safe for all of us. So for VA, it's no down payment, as well as no private mortgage insurance to pay. Your closing costs are capped. They're capped. And then there's a funding fee, which offsets the cost to taxpayers. The debt to income ratio on this one is, again, it's in the 40s, it's 41%. So yes, that's all for all my veterans, my VA, and their family members, so spouses and all, I want to say children, but I'm not sure. You got to check with a lender, but definitely the spouses can apply for this as well. So that is the benefit for that. So fixed and adjustable mortgage rates. I'm kind of going to go over this briefly. So just they kind of self-explanatory when you hear the term fixed versus adjustable. So a fixed rate is one where the mortgage rate does not change over the life of the loan. It could be either for 15, 20, or 30 years. Most commonly you may hear a 30-year fixed rate. That's usually, that's the most common type. And so for that, it's basically, like I said, the rate doesn't change, so your payments don't change. So this is really good for budgeting, and if you're planning to live in the house that you're buying for, you're trying to grow in it. It's for a good amount of time. We're talking about the next 7 to 10 years of your life. You're trying to grow your family in it. You gotta know what your payments are every single month. They don't change, all of that good stuff. It just depends on what's going on with you. If that's something that you're interested in, the fixed rate might be the better alternative. Now, an adjustable mortgage rate is one where they fluctuate with the market conditions. So they're going to change. They tend to be a little bit lower at the beginning, but they can change and fluctuate over time. So this is more beneficial if this is your starter home. You're really not trying to be in it for maybe no more than about 5 years before you're ready to move on. You can kind of get in and take advantage of the lower rates, and then hopefully be gone by the time they fluctuate. However, if you're there for a little bit longer, it can make it a little bit more difficult to refinance, because again, your rates have probably changed and it definitely impacts those mortgage payments. So that's all for part 2. That was part 2. Part 1 we went over last week. Go ahead and check that out if you want to get the information on that. But again, I'm going to make the disclaimer. Please connect with a lender, because your financial situation is going to make how you're eligible for these is going to impact that, your eligibility. So check and see what's available to you, so you can see how you can use the pros and cons to your advantage. Okay, so that's all I have for today. I hope all of this information has been helpful and enlightening. Again, I am on maternity leave right now, but please feel free to send me an email, send me a text message if you've got questions. I'm happy to answer them. If you need to be connected with the lender, I got you. I can connect you with the lender so you can go ahead and get started on that crucial part of the homeownership journey. All right, so that's all I got. Much love, take care, and I will talk to y'all later.